A wealthy investor with $1 million in U.S. government bonds collects around $45,000 a year in interest without touching the original million. That's close to a teacher's salary, earned automatically. Meanwhile, the middle-class saver with $50,000 in a bank account earns maybe $1,000 a year in today's high-yield savings accounts. Better than it used to be, but still not much compared to what's possible. Now here's the key point. If you had started buying a bond ETF 3 years ago, when yields were climbing, your $10,000 investment could be generating about $450 a year in income today. If you left that same money in a savings account, you'd have earned closer to $150 total. That's a $1,200 missed opportunity over 36 months on just $10,000. Scale that to $100,000, and it's $12,000 in foregone income. Today, we're going to break it all down: what bonds are, how they work, why prices move, the risks involved, and how you can use them through simple strategies like ETF and ladders to grow and protect your wealth. Let's make it personal. Imagine you're 30 years old and you invest $200 a month into bonds. After 3 years, you'll have over $7,200 invested and could be earning about $320 a year in income. Fast forward to age 65. That same habit could grow into a portfolio producing $12,000 to $18,000 a year. That's like adding a second Social Security check, a meaningful, steady income stream. But here's where it gets powerful. If you reinvest the interest payments every year, the snowball effect of compounding kicks in. Instead of topping out at $18,000 a year, your income could reach $22,000 to $28,000 by retirement. That's not guaranteed, because nothing in finance is. But historically, bonds have provided consistent income for those who stick with them. Now, if you're closer to retirement, the math looks different. For example, a $50,000 bond portfolio today could provide around $2,000 a year in income at current yields. Not life-changing, but enough to cover utilities, insurance, or travel, with far less risk than stock. What is a bond? At its core, a bond is a loan. You lend money. The borrower promises to pay you interest and then repay your original money, the principal, when the bond matures. Key terms: par value, usually $1,000, is the amount you lend. Coupon is the fixed interest. A 4% coupon means $40 a year on a $1,000 bond. Maturity is when you get your $1,000 back. It could be 1 year, 10 years, or 30 years. Issuer is who borrows: government, corporation, or city. Yield is your actual return, and it changes depending on what you pay for the bond. Think of bonds as renting out your money. The coupon is your rent check. The difference from real estate: no broken toilets. The payments are fixed, predictable, and, if the issuer is strong, highly reliable. How bonds actually work. Example: buy a 10-year U.S. Treasury bond for $1,000 at 4%. You collect $40 each year. After 10 years, you get your $1,000 back. Total return: $400 in interest, plus your $1,000 principal equals $1,400. If you reinvest each $40 payment along the way, compounding could lift the total closer to $1,480 or $1,500. Now compare with a high-yield savings account paying 4% on $1,000. That's about $400 over 10 years, similar to a short-term treasury. The difference is that bonds let you lock in the rate for a set period, while bank rates can change anytime. Types of bonds. Government bonds are issued by national governments. U.S. Treasuries are considered the safest in the world. They currently yield about 4 to 4.5% for 10-year maturities, and they're backed by the U.S. government's taxing power and monetary policy. The main risks are that inflation may outpace the yield, or that you face an opportunity cost if rates rise. Corporate bonds are issued by companies. They offer higher yields to compensate for higher risk. For example, investment-grade corporations may yield 5 to 6%. The risk here is default, but strong companies are relatively safe. Municipal bonds, also called munis, are issued by states and cities. They are often tax-free at the federal level, and sometimes at the state level too. A 3.5% tax-free muni might equal a 5% taxable yield for someone in a high bracket. These are best for high-income investors looking to minimize taxes. Bond ETFs. ETF stands for Exchange Traded Fund. Think of it as a basket holding hundreds or even thousands of bonds. Buy one share, and you instantly own a slice of all those bonds. The benefits are diversification, liquidity, and automatic reinvestment. They're best for beginners, or anyone who doesn't want to manage individual bonds. Finally, bonds can also be grouped by maturity. Short-term, 1 to 3 years, are stable with lower yields. They're best for retirees or near-term needs. Intermediate, 3 to 10 years, are balanced and popular with middle-aged investors. Long-term, 10 years or more, offer higher yields but are more sensitive to interest rates. Younger investors can usually handle the swings. Why bond prices change? Rule of thumb: when interest rates rise, bond prices fall. When rates fall, bond prices rise. If you own a bond paying 4% and new bonds pay 6%, your bond becomes less attractive. Its price drops until the yield matches the market. But if you hold the bond to maturity, you still get your coupon payments and your full principal back. The price fluctuations only matter if you sell early. That said, holding to maturity doesn't protect you from inflation risk. If inflation averages 5% and your bond yields 4%, your real purchasing power declines over time. Now, let's talk about risks and how to mitigate them. Credit risk. U.S. Treasuries have virtually no default risk. Corporates vary, so you use credit ratings. AAA is safest. Junk is riskiest. Interest rate risk. Bond prices move opposite rates. To mitigate, buy shorter-term bonds or ladder maturities. Inflation risk. Yields may lag. Inflation. To mitigate, use TIPS. Treasury. Inflation-protected securities. Reinvestment risk. Coupon payments may reinvest at lower yields if rates fall. Laddering helps smooth this out. Liquidity risk. Some bonds are harder to sell quickly. ETFs solve this with daily liquidity. No investment is truly risk-free. Treasuries minimize credit risk, but inflation and opportunity cost remain. Now let's look at some simple bond strategies. Sample portfolio blends. For retirees, age 65 and older, 70% short-term treasuries, 20% high-grade corporates, and 10% munis, with a focus on stability. For middle-aged investors, ages 40 to 60, 40% treasuries, 40% corporates, and 20% munis. For younger investors, ages 20 to 40, 30% treasuries, 50% corporates, including some riskier ones, and 20% long-term bonds, with a focus on growth and income. Basic laddering. With $5,000, you could buy 5 $1,000 bonds maturing in years 1 through 5. Each year, one matures and you reinvest at current rates. This provides liquidity, protects against rate changes, and creates predictable cash flow. Finally, bond ETF versus laddering. ETFs offer instant diversification and are easier to manage. Laddering gives you more control and fixed payout schedules. Historical perspective. In the 2008 crisis, stocks fell over 50%. Treasuries rose and coupon payments continued. Bondholders preserved capital. In the 2020 pandemic crash, stocks lost 34% in just weeks. Treasuries surged as investors sought safety. Bonds don't always go up, but they consistently provide income and tend to protect portfolios during crises. Here's the move. Open your brokerage account. Search for bond ETF, an easy way to start. Buy a small amount, even one share. Set a recurring investment, like $100 per month. If you're young, lean toward longer-term or corporate exposure for growth. If you're near retirement, focus on shorter-term treasuries for stability. High earners should look into municipal bonds for tax savings. Bonds aren't glamorous. They don't make headlines, but they quietly build steady wealth and protect portfolios when the stock market crashes. If you found this helpful, subscribe to learn more ways to grow your wealth safely and smartly.